Good morning and welcome to this special edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for Tips for Trading Success. Now, before we get started, I do want everyone to be aware that we are having our upcoming Market Vision 2023 event. It will take place on Saturday, January 7th. I've got some experts coming over from StockCharts, good friends of mine. They're going to share their vision for 2023, give you some great information, some knowledge as you head into the new year. All you have to do is go over to earningsbeats.com and you will see this link. You can click on the link to register. This is a free virtual event, so there's no cost whatsoever, no credit card required. All you need to do is go over and sign up with your name and email address. You can then take a look at some of the past predictions that I've made over the last few Market Vision events. This will be our fourth one. And if you keep scrolling down, it'll just give you more information about the event, the speakers, and so forth. Really looking forward to it. We have such a great time. And we do this for the community. It's a Saturday. I've got three great speakers, good friends coming over from StockCharts on a Saturday. They're doing it out of the kindness of their heart. We really appreciate them coming over and joining us for the event. But mark your calendar. Mark your calendar. This is going to be a really, really big event, and the capacity, we will run out of room. So you want to make sure that you're registered. Also, if you can't attend that day, there will be a recording that we will send out. So you can always look at it at your leisure. The recording will be time-stamped so that you can go right in and take a look at the area that interests you most. Anyhow, just please be sure to go over there and sign up. So today what I want to do with tips for trading success is just go through a few things. This is a 30-minute show. Obviously, I cannot possibly go over everything that we need to talk about in terms of trading in a 30-minute episode. I want to give you some things to think about. So as we go through this, just keep in mind, there's obviously a lot more to discuss about these topics, but I'll give you maybe just a little bit of a quick outline. So this is what we're going to talk about today. Number one, the big picture. Never lose sight of the big picture. Number two, relative strength. Number three, sentiment. And number four, outside influences. And I'll go over those with you as we go through the show. But let's go ahead and start off with this big picture, because this is a very important concept to me. I never lose sight of the big picture. This is a 100-year monthly chart of the S&P 500. And you can see I've got red shaded areas where we go through these secular bear markets. And then these blue directional lines will show you and highlight the secular bull markets that we're in. So we go through these different periods from a really big picture. Again, 100-year chart. I don't know about you. I wasn't trading 100 years ago, but it does kind of put everything in perspective here. The long-term picture for stocks, as you can see, is higher. We continue to go higher. Everyone always thinks, oh, this is the one. This is the one's going to take us down. This is the one. 1970s, remember, higher interest rates, the inflation, the oil embargo, lots of things going on back then. We had Vietnam, crazy stuff. The 1930s, 40s, late 1920s, of course, that's when we had the crash. Really bad periods. The 2000s, we had the dot-com bubble. We had the financial crisis in 2007 through 2009. And yet, where were we when we started 2022? At an all-time high. We took everything that's been thrown at us and we just keep going higher. Over time, you have to believe we're going higher. If we don't, nothing's going to be worth anything. So you need to at least try to go into looking at the market with mostly rose-colored glasses on. There are going to be times when the market doesn't look good. And you want to try and get that at the top, not after the market sold off. A lot of folks are trying to get bearish now. Oh, I've lost 30% in my retirement. Let's get out now because the worst is yet to come. Well, it's only worked in a couple of cases. So please be careful. Understand that right now, even though we've had a rough 2022, this is still very much a part of a secular bull market until proven otherwise. At the beginning of 2022, actually, I just mentioned, we've got Market Vision 2023 coming up January 7th. Well, this was a chart that I gave in January of 2022, January 8th, 2022, when we had our last Market Vision 2022 event. And at the very end, this is what I gave everyone. This is what I thought was going to happen. Now, if you just look at the price action from 2009 low, connect these major lows, 2009, and then the 2020 pandemic, connect that line, and then drag that line. You can do that on StockCharts when you annotate. You drag the line up here so that you have the same slope, and I connect the highs. And if you noticed, it's pretty darn close to hitting every high. Notice what happened, though, in 2021. We went outside the channel to the upside. We had, I don't have time to go through everything, but I was looking at a 22-month rate of change. So you look to see where we were at the end of 2021 and where we were 22 months earlier, and you calculate that percentage change. It was roughly 115%. I can tell you that anything over 50% is crazy bullish. 115% at the end of 2021 was the highest 22-month rate of change since back in the 1930s. Markets can't sustain moves like that. Now, granted, it was coming off of a panicked low. They all are going to be off panicked lows when you have that kind of movement to the upside, because you just don't go up for a few years, year after year, go up 10%, 10%, 10%, and then all of a sudden go up 115% over 2 years. That's not going to happen. Normally, that kind of move is going to come off of a major panicked bottom, like the one we saw back in 2020. But still, you can see we were out of this channel. And so what I suggested is that, I wasn't looking for us to come down to hit one of these panicked lows, but what I felt like we probably were going to do in 2022 was go back down to this midpoint of this channel. And if you look back, 2009, 2011, 2016, 2018, and then maybe even here a little bit after the pandemic, maybe in June of 2020, we went back down and tested this area. So this was part of my forecast last year. I really thought the market needed to pull back. I didn't say it was a guarantee. What I said was there were a lot of risk factors pointing to the market topping, and that we could see a low over the next 3 to 6 months. This was back in January. We could see a low as low as 3,500 to 3,800 on the S&P. That was when we were at 4,800. This was the chart after. Now, got the first half of the year really right. Second half has been much more choppy. So it hasn't been down and then back up. And then through the year, talking to members, I said, we could probably extend this out past the 6 months. I thought it could go out to September. And we ended up with another bottom just below the June bottom that occurred in October before we started to rally again. Now, we've pulled back again. We are right on this, as we speak, we are right on this midpoint of the channel. Are we going to go higher or are we going to go lower? I don't know. Nobody knows. You have your opinion. Some think this is, an opportunity to short. We're going a lot lower. Some think it's an opportunity to go long. We're going to go a lot higher. That this has been a great opportunity. Finally got the pullback everybody wanted. That's the thing from a sentiment standpoint, the mindset, psychological part of trading. When the market's going up, you say, man, I really wish we get a pullback. I really wish we get something significant so I can get in. Then you get the pullback and you're like, oh my gosh, this is the worst thing ever. We're going to keep going down. This is, never going to end, going to zero. It's the mindset. You start getting into a mindset that, hey, this thing's spiraling lower. It's getting out of control. Never be the same. It'll be the same. We'll go back to all-time highs. Is it going to happen in 2023? I don't know. I'll talk about that more at Market Vision 2023 coming up. But this is just a chart I think you need to be aware of. We were way overbought coming into 2022, but look at where we are now in this channel. It's a much different picture going into 2023 than it was going into 2022. Hard to argue that. Just look at the chart. Charts don't lie. I don't listen to CNBC personally because most of the folks on there, I'm not sure what their agenda is, but the charts don't lie. This tells you exactly what's going on with the money. All right. I want to talk a little bit about divergences because I just gave you a great big chart. Now I'm going to give you a 1 month chart. So I just went back 100 years. Now I'm going to give you a 1 month chart because just recently the S&P 500, after gapping up with the CPI news that came out, then we had a Fed meeting the next day, and you can see this is where we had the big drop after the Fed meeting. But notice how prices keep going down, and the PPO is a momentum indicator. It's the difference between, well, the default is the difference between the 12-period EMA and the 26-period EMA, exponential moving average, on a percentage basis. The difference between the PPO, you might follow the MACD. The difference between the PPO and the MACD looks at the same difference between those the 12 and 26 period EMAs, but it looks at it in terms of dollars. The MACD think dollars. PPO think percentage. All right. But both, if you put them on a chart, the PPO and the MACD are going to look very similar. Many times you're not going to be able to see the difference. In the short term, one thing that I look at from a trading perspective to give me some clues about the market is when you're going down like this, look at the PPO going down, down, down. Well, you'll reach a point sometimes where you go down, you bounce, and you go down again. But the PPO, the difference between your moving averages, starts to converge instead of diverge. So here, as you're moving down, your moving averages are diverging. Your 12-period, in this case, 12-hour EMA is moving down much faster than your 26-hour EMA. That's why that PPO goes down like that. Okay. But after you have a couple of these moves back to the upside, eventually, a lot of times you'll get to a low and you look and you say, wait a minute. The PPO is starting to turn up. So now instead of that 12-period EMA pulling away from the 26-period EMA, we're actually seeing the 26-period catch up. And that's when the PPO starts to roll back over and head in the other direction. That's referred to as a positive divergence. Now, I don't see any on this 1 month chart, but if the same can happen in reverse. So a lot of times when you're moving up and you're looking for maybe a top in the market, watch your hourly chart. Many times you move up, you'll pull back, you'll go to a new high, you'll see the PPO go to a new high, and you'll keep doing that for a little while. And then eventually you get to a new high and you see that 60-minute PPO roll over and you get a negative divergence. These can be very important short-term signals. Look at the S&P here. There's that positive divergence. Here's the move down, and there's your rally back up. Now, these divergences, you really need to look at in terms of both short-term and longer-term charts. So this is a 60-minute chart. A lot of times, all you do is you reset the PPO. PPO gets back to the center line. Price action gets back close to the 50-day moving average or maybe near a prior price support, which now becomes resistance. And then we roll back over again. So these divergences act in, kind of in concert with other indicators that you might use. But you have to go from the hourly out to the daily, because the daily, sometimes I'm looking to see here. Look at this low down here in October. See how we're going down? See how the PPO keeps going down at every low? We have a lower PPO. Look what happened down here, mid-October. Look at the PPO turn up. That was a major change in the market for a while. At the very top, we tried to break out at 4,100. Look at the PPO rolling over. What happens? Market comes back down. You need to be aware of these divergences that set up. The other thing that you need to be aware of simply is overbought and oversold. I mean, I'm not going to get into details. There are certain ways I like to trade it, but we don't have time to get into a lot of that. But basically 70 on the RSI is overbought. So here we get to 70 right around August 11th. And by the 15th or 16th, we're topping, coming back down. Look at the bottom. I mean, as we approach this bottom right here, it was just a short-term bounce. But you have to be aware, if you're shorting and you're way oversold, it might not be a bad time to take some profits. If you're on the long side and you're overbought, might be a good time to take some profits. You want to be aware of the overbought, oversold conditions. All right, let's move on. Let's talk about relative strength a little bit. So one of the chart lists I keep at Earnings Beats for our members, and you can keep these over at StockCharts. StockCharts is my platform. I love StockCharts. I just love the way I can organize everything. I love the chart list and the way that this is all designed. But I've put into one chart list the 11 sectors. And I have this set up not for the absolute price, but for the relative price. So this is technology, the XLK, divided by the S&P 500. So when you're in one of these bull market moves and you know technology is leading, guess where you can trade and have better odds of outperforming? Technology. It's a winning group in an uptrending market. That's what you want. You need to know what's leading the market to the upside. You need to know when you're going through periods where technology is out of favor. 2022 has certainly been that period. I mean, when we got that nice rally back June through July and into August, you can see technology led that move. But by the middle to the end of August, we had rolled back over. This was not a good looking chart. And technology has continued to drift lower. It's now below its 20-week moving average. Now, again, this is a relative price action. So that's your relative 20-week. There's your relative 50-week. But this is bearish configuration. PPO below the center line, relative PPO is in negative territory, and the price action is below the 20, which is below the 50. That's normally not going to get it done for the bulls. We need to see more relative strength there. But you can go through and you can do this with all the sectors to see what's leading and what's not. Now, remember, you've got 11 sectors that make up the S&P 500. So at any given time, something is going to be leading the S&P 500. They all can't be downtrending relative to the S&P 500. Something has to be uptrending, probably a few different groups. You need to be aware as we go through different cycles in the market, which groups are leading and which ones aren't. Then we can take a look at the industry groups. So now what I've done, you'll see this numbering system I have. I just put 001 to mean XLK. So every chart starts 001 XLK. And then I break down the 8 industry groups within the technology group. I label those 01, 02, 03 down to 08. So I can get them in order, but I can put them all together as technology industry groups. That's why I start off with the 001. When I get to discretionary, you can see all the discretionary groups I have is 002, XLY, and then I put 001, 002, 003 for each individual group. But I can quickly, now there are 104 charts on this list. And again, this is something that we actually allow our members at Earnings Beats to download from us if they're annual members. This is one of the charts that we went through, took a lot of time to put together. And the whole chart list can be just downloaded into your account if you're a StockCharts member. Anyhow, looking at this, I mean, I can go through very quickly and see what's leading. Semiconductors have been downtrending for a while. They're trying to get better. They're now above the 20-week, which is good, but they're not above the 50. We still have the PPO in negative territory. It's moving up. That just means that the selling momentum, the relative momentum to the downside is slowing. It doesn't mean you have leader necessarily until you are trading on a relative basis above the zero line. Like back in 2019, 2020, this is where you can see semiconductors were a great area to be in. You wanted to be in semiconductors. But I can go through and I look at every one of these charts. And, you might say, well, I want to just zero in on staples. I'm pretty defensive right now. Well, go down to 007. Here are the staples groups. You say, okay, here's the Brewers, got a little bit of an uptrend, trading relative PPO above the zero line. Longer term, it's not a favorite group of mine, but in the near term, if you're, cautious, this might be a group where you find a trade or two that look pretty good because it has been uptrending throughout 2022. How about food products? Look at food products relative to the S&P 500. It's awesome. When you're trading, now, granted, a lot of traders are looking for, big moves up, big moves down. Well, probably not big moves down unless you're shorting. But sometimes when the market is going through these periods of whipsaw and, very choppy, sometimes trading some of these more defensive areas is not a bad idea, especially if you're an income, more of an income investor, but you want to try and make some money. A lot of these consumer staples companies pay nice dividends. So you can be looking for both capital appreciation and the dividend income. But when I want to trade them is when they are trending up, like food products is right now. So there's a lot of different ways you can use these, but pay attention to relative strength. If you want to outperform the S&P 500, you need to do it with groups that are outperforming the S&P 500. It's much easier that way. So just be aware of what's going on with relative strength. So let's move on. I want to talk about sentiment for a second. This was a chart I showed back in Market Vision 2022. This is the equity-only put-call ratio. It's a daily chart, but what I did is I made it invisible, so you can't see the daily readings of the equity-only put-call ratio, because you would just see this thing going up and down and up and down. It wouldn't make a whole lot of sense to you. I smoothed this out with a 253-day, which is 1 year. 253 trading days is basically 1 year. And I smoothed it out. And what you'll notice is that when the equity-only put-call ratio reaches a low, it's telling you that there are a lot more calls being played than puts. And so after you've been going down for an extended period of time on this lagging 1 year indicator, if you've been doing this for a long time in one direction, chances are the market's getting ready to flip. And when it does flip, you need to be aware, because here, as it was going down, we had a nice little rally in the market, 20% over a year. But look, while we were trending up in this ratio, during that time, the S&P 500 dropped 50%. Then we get to the point where we're way too bearish and the market starts to move in the other direction. Well, here over a 2 year period, 101% gain. Then we bottom, we turn back up, the market struggles. We top, we come down, the market takes off. We bottom, we move up, the market struggles. We top, we come down, the market takes off. This was a real choppy period, 18 through 2020. Definitely probably gave us a lot of false signals. I admit that. Looks like it was rolling back over, and then it's going up, then it's down, then it's up, then it's down. And you can see the action when it was going up right here. Well, actually, this whole area right in here, from here to the top, you can see the market didn't do anything. But when we started coming back down, market took off. Then we go up, market dropped. Then we come back down, and then we had the big, big rally. But I mentioned this at the beginning of January. I said this was turning up. That is going to make for a very difficult market if history tells us anything. Sentiment, you've got to be careful, because sentiment can go in either direction. And when it's too far in one direction, the market is likely to move in the other direction. We're likely to get a reversal. Look at where we are now. Can you see the difference where we were at the beginning of 2022 versus where we are now? Now, there's a lot of crazy stuff going on in the daily readings. I'm not going to get into that today. I think this is a little bit inflated right now. It still likely would be going up anyway, but it's definitely inflated because of some of the daily readings that we're getting, which is just crazy. I will be working on my own user-defined index on the equity-only put-call ratio to try and weed out the noise of some of what I think are just some misleading equity-only put-call ratios. But again, I don't have time to get into all that in this show. But the big takeaway here is when we get too bearish and this starts to roll back over again, you're pretty much done with any movement to the downside. So there are some who are saying, well, we're still going up. So that means, maybe we go all the way to this peak. And so the market could keep going down. It looks like it's rolling over again. Hey, if that's your interpretation, that's fine. Big takeaway for me is this market from a sentiment standpoint is completely different. We have reset sentiment. And that was the word I used back at the beginning of 2022. We need to reset sentiment. All right, how about outside influences? So I want to just show you first a historical trend that maybe you're aware of, maybe you're not. But if we pull up seasonality over here and we pull up the DJUSHB, this home construction, and let's just go back to 10 years. That's when the market really started to take off back in 2013. I want you to look over the last 10 years at home builders in November, December, January. And I'm going to actually show it relative to the S&P 500. And again, let's go back 10 years. November, December, January, right here, 3.7. That's 6.1% of relative outperformance that the home builders have enjoyed in these 3 months. It's way better than any other quarter, any other 3 consecutive month period, again, over the last 10 years. And if you look at the chart of home builders, look at what it's been doing, November, December. Now, if I tell you at the beginning of November that home construction does well in November and December and January, does that guarantee you it's going to go higher? No. But you're now aware that there is a seasonal tendency. And this is one person I don't think makes a whole lot of sense, but it is what it is. How about money flows? You're not going to believe this, but if you haven't heard this already, but I'm just going to give you money flows. I'll just leave this chart up. I'll just give you some numbers here. The S&P 500, beginning of the month, a lot of money flows into the stock market, coming from mutual funds, money actually from 401ks into mutual funds, that sort of thing. The first of the month. Now, keep in mind that the average annual return on the S&P 500 since 1950 is 9%. So if every day was created equal, we would have 9% annualized returns on every day of the month. But the first of the month, it's 45%. Second of the month, 39%. Third of the month, 22%. Fourth is 9%. Fifth is 28%. Sixth is 18%. We go to the end of the month, the 28th is 23%. 29th is 19%. The 30th is 10%. The 31st is 25%. Every one of those days, 10 consecutive days in a row, every one of those is above 9%. When do you think you have your best chance to make money in the stock market? If you say any time other than the 28th to the 6th, you are wrong. And this is based over 72 years. It's not just what happened the last couple of years. On the flip side, the 19th to the 25th, horrible. All the days are below that 9% level. And the annualized return for the 19th to the 25th, that period as a whole, minus 7.6% since 1950. That's a full 16 percentage points below. That's a time you need to be very, very careful in the market. You don't go in. So what happens if you go into the 28th of the month and you got a positive divergence on the 60-minute chart? Hey, you're starting to line up some things. What about if you have a negative divergence and you're heading into the 19th? Then you've got options expiring, which can be very bad for the market. You've got to put all these things together. Anyhow, I'm going to talk about some of this stuff more when we get into Market Vision 2023. But right there, go back to earningsbeats.com, sign up, click on that link and sign up with your name and email address. I'd really love to have you. It is free, no credit card required. Listen, have a great day, and I hope some of this helps in your trading. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.